Hey, Mad Money fans, check the bottom of your screen for an exclusive offer. Next.
In tonight's special survival guide edition of Mad Money, we're discussing how to deal with brutal sell-offs. Specifically, how to defend against them, take advantage of them even, because you know I like to be opportunistic. Now, I've told you not to be glib about the systemic risk sell-offs that involve the potential collapse of the U.S. economy. But those are easy to spot because it'll seem like the world's falling apart, like in 2008. You don't need me for that. But now I want to help you game out the other less dangerous kind of crash, the mechanical kind, caused by a broken market in a healthy economy. Now, the best way to deal with these sudden declines is to recognize that there's a bottoming process, one you can spot. So what should you do? I have a solution that has worked in even the toughest of times. I like to look at something I call the accidental high yielders. I actually call them AHYs on this show. Those are stocks of companies that are doing fine and have good balance sheets. That's very important, by the way. But their share prices have fallen so low that their dividends are starting to give you an unbelievable return. That's right, good yield. How do you spot these? When you look at the historic level of dividend yields you've gotten from certain stocks, you also want to look at the yield of the 10-year Treasury. If a stock typically yields, say, 2%, suddenly it's paying double that because of a market-wide decline, then you're probably looking at an accidentally high yield, as long as the stock's been going down for no particular reason. And that's why when you're hunting for these dividend stocks, you should focus on companies that aren't particularly sensitive to swings in the economy that have very good balance sheets. Second, if the yield level isn't giving you opportunities, I'd use a mechanical sell-off to pick some stocks that you like. You can begin buying them using what's known as wide scales. That's why I recommended during the 2010 flash crash, I told people to use wide scales. Pick one of your best stocks out there, premier stock, and buy some using limit orders only. Don't use market orders because you might end up getting terrible prices. Frankly, you should never use market orders because it's especially stupid during a crash. I like this method because if the market does come right back, as it did after the two flash crashes, you've picked up some terrific merchandise at amazing prices. Then you can flip the stocks for big profits, or you can hold on to them for the long haul. But take a look. I actually demonstrated exactly how this works during an appearance on TV when the flash crash happened in 2010.
P&G is now down 25%.
Oh, well, if that's true. If that stock is there, you just go and buy it. It can't be there. That is not a real price. When I looked at it, it was a 61. I'm not that interested in it. It's at 47. Well, that's a different security entirely. So what you have to do, though, you have to use limit orders because Procter just jumped 7 points that I said I liked it at 49. So, I mean, you got to be careful.
The market was down 900 points. We're now down 688.
So remember, I buy 50,000 at 49. I now flip it at 59. I just made 500 G's. Yeah, that's the craziness of what I'm talking about. And by the way, a lot of people end up doing that Procter trade. I've been thanked for millions. Like a dozen times people thank me. Remember, the limit order advice really does ring true. Now, we've talked about meltdowns and true systemic risk and gut-churning moves that are untethered from the economy. But how about the garden variety pullbacks we experience all the time? What causes these declines? Well, there are usually a bunch of different varieties. First, you've got the sell-offs caused by the Federal Reserve. That's probably the most frequent reason for stock dumping. There's a reason that business media constantly talks about the Fed. When the economy is weakening, it's the Federal Reserve's job to try to restore growth, which they did with aplomb when COVID shut down the economy in 2020. As long as the Fed's printing money, almost every decline is a viable one. It's just a fact of life. It's been like that since I got into business. But when the economy is strengthening and perhaps starts to overheat, well, the Fed has a different mandate, stamping out inflation. When the Fed declared war on inflation in late 2021, the market started rolling over with the highest risk groups getting eviscerated. Now, nobody wants persistently high inflation. Those of you who missed the 70s and 80s now know from the post-COVID experience. But we also don't want the Fed to break the economy like it did when it raised rates 17 straight times in lockstep going into the Great Recession. It caused the Great Recession. Now, there are plenty of times when the Fed's tightening, but the stock market didn't get crushed because the economy didn't get crushed. And that's how we got the incredible bull market in the first half of 2023. However, whenever the Fed tightens, some prognosticators will come out of the woodwork to tell you the market will crash or at least take a very big header. That's inevitable. So when you hear these comments, please don't panic. Fed rate hikes don't necessarily lead to crashes. In fact, I've seen plenty that do next to nothing. But there are rational reasons why the stock market deserves to go down when the Fed tightens, and I'm not ignoring them. First, stocks are only one of the assets available to individuals and institutions. For instance, there's gold, there's real estate, of course, there's bonds. I like gold as a safe haven, and I believe that every person should hold some gold, preferably bullion, but if not, then the GLD as a hedge against economic chaos. Real estate, actual real estate can be a good hedge, but most people don't have the money to invest in that kind of real estate that big institutions can buy. Now, we do have real estate investment trusts, but they're not as reliable a proxy for real estate as a whole. Finally, we have bonds as an investment alternative, and bonds are the source of the problem when the Fed tightens. You've seen it yourself. When short-term treasuries give you more than 5% risk-free, lots of people cash out of the stock market and park their money in treasuries. Hey, listen, it's not a bad return. As the Fed tightens, bonds, particularly short-term pieces of paper, become more competitive with stocks. You'll notice as the Fed jacks up rates, high-yielding dividend stocks are going to be among the worst performers because suddenly they got some serious competition from fixed income. So please be careful of these dividend stocks as safe havens when you're dealing with a sell-off caused by the Fed. They're very different from accidental high yielders that can spring back when the Fed starts tightening. The second reason why stocks can go down legitimately when the Fed raises rates, because the Fed isn't perfect. They've raised rates when they should have stood pat or even been cutting rates fast because the economy was already slowing rapidly. Although in recent years, Jay Powell has been much more responsible about not pushing us off a cliff than some of the previous Fed chiefs. Here's the bottom line. Garden variety pullbacks can be gamed as long as there's no systemic risk involved. But sell-offs in the wake of the Fed raising rates, those are trickier, although they can lead to decent opportunities. As long as you stay away from the high yielders that become less attractive when the Fed tightens, and stick with the accidentally high yielders that might just give you the delicious bounce when the Fed's done tightening. Mad Money will be back after the break.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.